Alright guys, so let's talk about China's trip to Europe. So Europe is in a state of confusion. Now part of them wants to continue trade with China, but they are trapped in a very bad situation. Because of the decoupling with Russia, cheap energy is over. Thanks to this, European products simply can't compete with Chinese goods. Now Europe's fear is very simple. If they keep trading with China, allowing all the exports to come in, the cheap goods will crowd out their own domestic goods. In a report, it is projected that Chinese cars will comprise a quarter of Europe's total EV sales. Because of the quality plus the price point, Europe simply can't compete. There's at least a price advantage of 30% and in some cases over 50%. There's simply no way to bridge the gap if Beijing sells at those prices. Just after the talks with President Xi and Macron, von der Leyen went on the stand to warn China. She said Europe is ready to use all trade tools to punish Beijing. It's basically the fear of Chinese steel and EVs flooding the European market, the fear of Chinese goods winning market share. And we must take this quite seriously because there's a chance Europe might indeed put up trade barriers to block Chinese imports. Obviously, this won't be good for both China and the EU. The Chinese need to keep exporting out to grow their industries. Hitting their 5% GDP target isn't going to be easy, and the domestic market is still recovering. China's exports of cars to Europe are increasing exponentially. It has gone from under $1 billion in 2018 to almost 20 billion in just 5 years. In fact, it is almost on par with Europe's own car exports to China. The surplus in auto trade Europe is enjoying is about to become a deficit. Around 40% of Chinese EVs are sold into Europe, so losing this trade won't be good for China. What the EU is worried about isn't really China's overcapacity. It revolves around Europe's inability to compete. If we leave it to free market dynamics, it's obvious which people would buy. The Chinese product would win hands down. The reason why Chinese cars are cheap is because of the entire supply chain, not just factory capacity. All the inputs in a Chinese factory are optimized for low-cost production. You have cheap power, abundant raw materials, automation, and fleshed out transportation. All these contribute to a cheaper price tag. But it doesn't really matter. At this point, the EU is really afraid, and there's a very good chance they might simply lash out. During the press conference, von der Leyen revealed the fear she has. Europe cannot accept market distorting practices that could lead to de-industrialization here at home. Europe wants China to be less competitive, to give EU companies a chance to survive. Now, if China doesn't play ball, Europe might cut away their markets. And this is essentially a Mexican standoff. Things can spiral down to a lose-lose situation where the EU market starts decoupling from China. And in return, China starts putting up barriers against European trade as well. Listen to what von der Leyen had to say about Chinese trade.
As we have shown, we will defend our companies, we will defend our economies, we will never hesitate to do so if this is required. Chinese subsidized products, these subsidized products such as the electric vehicles or, for example, steel, are flooding the European market. At the same time, China continues to massively support its manufacturing sector, and this combined with a domestic demand that is not increasing, the world cannot absorb China's surplus production.
So she lays it out quite clearly. She's angry that China is massively supporting their manufacturing sector. She's also furious that China's domestic demand is not improving, which is causing these products to flood into Europe. But there are some points here we need to make clear. Subsidies from governments to certain industries are new. The US also plays the same game. The Inflation Reduction Act, for example, provides a 30% tax credit for investments in wind, solar, and other renewable energy projects. This is a subsidy to build up their industrial base and to attract investment in. As a result, within just a year, companies poured over $100 billion into clean energy manufacturing. Today, the US is increasing their subsidies to bring in companies like TSMC to American shores. Now, in 2019, studies found that China's industrial subsidies amounted to over $221 billion. That's 1.7% of China's GDP in that same year. That's multiple times more than what South Korea and even the US allocates to manufacturing. But trying to blame China for your own industrial policy isn't the way to go. This sudden change wasn't an overnight affair. China has been investing for years at a very huge scale. The problem the EU has is the lack of coordinated industrial policy for the entire bloc, which really shouldn't be the case. You have the ECB, the European Investment Bank, the EIB, and the European Commission. Creating a fund for industrial production shouldn't be that difficult. 3 years back, China was already spending an insane amount of money building the future. In total, Beijing spent $260 billion to develop renewable energy and their EV sector. Conversely, the biggest EU subsidy came from Germany at only $48 billion. There's a big gap that needs to be filled, and this is only for one financial year. There's a decade of catch up the EU needs to do to compete with China effectively. That won't be easy. It will take a lot of time and a lot of money, things that Europe simply doesn't have today. And here's how much money Europe has to spend. Just to catch up with the US, not even China, the EU will have to spend a bomb 650 billion euros annually until 2030. And for the next decade, this will have to hit 800 billion euros a year. However, there's a big problem. Raising the money today is near impossible without incurring a huge debt burden. Interest rates are no longer low, they are very high. Europe is also fighting the Russians by giving Ukraine a lot of money. The EU has agreed on 50 billion euros of financial support to Ukraine until 2027, and this is money that could be channeled towards manufacturing instead. As we said before, it is impossible to fund a war and build your own civilian industries at the same time. The war is financially hammering Europe's economy, and this is becoming more evident when we look at the disparity between EU industries and China. But let's address the issue of weak domestic demand in China. This is a constant issue the US and Europe hammers on to prevent Chinese exports from flooding their markets. During her trip to China, Janet Yellen had a message for Beijing. She told officials to change Chinese economic strategy for growth, that the industrial push will hurt the US and Europe as well. The whole idea here is to get China to focus on boosting domestic consumption, to give subsidies directly to households to spur spending and bring down high household savings rates. Now, these are policies that China is already trying to push. There's the trading program for consumer goods that's coming. The government will give consumers subsidies to upgrade their industrial and household equipment. Just in cars alone, this is expected to generate around 380 billion yuan of demand this year. That's around $53 billion. In total, Goldman predicts this will increase GDP growth by 0.6% in 2024. But these are just the estimates. There's no guarantee that the trade-in program will work like a charm. Trying to boost domestic demand while the property sector is still imploding is like trying to swim against the current. There's only so much you can do. You have to wait for demand to recover organically. Chinese households are still cautious about spending. Before 2020, China's savings rate was around 30 to 31%. It spiked all the way to nearly 38% when the lockdowns began. Today, it is still above 34%. The property collapse is delaying the recovery. It's going to take at least a year or maybe even 2 years for things to normalize down. And during this period, China still needs to export their goods to other markets. This includes Asia, Africa, the US, and of course Europe as well. So something has to give. Europe can't afford to decouple with China while Beijing needs to work out a way forward to keep trading with Europe. Both sides still need one another. Thankfully, there might be a way out, and it's actually coming from France. Now, while von der Leyen was busy scolding China, the French gave a roadmap. And this is probably how China can keep selling to Europe. There has to be some give and take for Europe to keep the doors open. The French finance minister declared France was open to Chinese investment in the EV sector. France welcomes all industrial projects. BYD and the Chinese auto industries are very welcome in France. In other words, you can build your cars in France. You can manufacture using EU rules, French workers, and the energy available in France. You can then sell your cars to the common market without restrictions. And this might be the playbook for Chinese goods entering Europe in the future. And if you think about it, it might be the only way left. France wants to build up their economy, and China needs the EU market still. As much as Europe wants to decouple from China, they can't build affordable EVs without Chinese supply chains. Beijing is light years ahead in mineral refining and manufacturing. It's all made in China. The renewable supply chain is almost completely Chinese. Over 80% of all inputs are from Beijing. Polysilicon, battery cells, cathode and anode are all necessary for the production of EVs. And the entire supply chain, almost 90% of it, comes from China. it is impossible to build an EV that can compete in price without Chinese inputs. France also needs the technology and expertise China can provide, and this allows them to catch up with German manufacturing, which is still well ahead. But does this make sense for China? Well, considering the situation, it actually does. Chinese companies have more to gain from this partnership as well. Consider the situation back in China. There's a very brutal price war going on. The volumes might be up, but profits are actually heading down. BYD sales are up by 10% in Q1 this year. However, their gross profit is estimated to decline by 19%. The cost of manufacturing the car is so cheap that automakers within China itself are slashing prices to get market share. It's great for consumers but painful for the automakers. However, profit margins for cars sold into Europe are very lucrative. BYD makes 14,000 euros in profit selling to the common market versus just 1,300 euros selling in China. That's 10 times more profit at least. Even if they manufacture in France under Eurozone rules, the math might make sense. China is very familiar with this playbook. In Hungary, Chinese companies are investing $10 billion into the country. They are building battery plants to supply German automakers and EVs to sell into Europe. We could see a bifurcation of markets, a splitting of Chinese EV manufacturing, one where companies produce cheap stuff for the local Chinese market, made in China for the Chinese people, another where cars are built in Europe according to EU standards but sold at a higher price, made in Europe for the EU customer. This will provide employment to Europe without totally cannibalizing EU automakers. Now, the big losers, of course, will be the EU consumer. This might seem unfair to China, but that might be the only playbook left. And let me put it bluntly, to sell into the common market, China will have to subsidize Europe's industries, plain and simple. It's like a bailout for Europe, saving them from the bad decisions made over the past 5 or 10 years, saving their industries while the EU spends money fighting Russia. And if I was a betting man, I believe this is the only way out for EU China trade, especially when it comes to EVs and solar panels. Chinese factories, they have to set up shop in the Eurozone. And this is where China does have the advantage. Chinese firms are investing abroad at the fastest pace in 8 years. It's all about building factories to create jobs to keep the doors open for exports. And this is simply a math problem. If the economics works, Chinese companies will pour the money into foreign direct investment. Chinese investment overseas has reached $130 billion in 2023 and is going to grow further this year. This is the highest point on record since 2016. Trying to flood the world with exports without giving back probably can't last forever. China has to help countries in the world produce stuff overseas to grow their own economies. The big question now is if Europe will welcome Chinese factories. Beyond just France, can China invest elsewhere? The US has blocked entry into Mexico, and there's a chance that China could face real problems in Europe as well. We'll just have to wait and see. But let me know what you think. Will China build a factory in France? Can Europe accept Chinese investment coming in? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these crazy times.